The market is currently closed for the weekend, having concluded the last session with Plug Power Inc. (PLUG) trading at a closing price of $2.20 per share on Friday, December 5, 2025. That final price marked a daily decrease of 0.03 cents, or approximately a 1.35% drop on Friday's action, after an intraday range that spanned from a low of $2.18 to a high of $2.32. This recent dip, however small in absolute terms, masks a far more critical recent development: the successful execution of a $375 million convertible senior note offering in late November, which allowed the company to significantly clean up its balance sheet by eliminating a substantial portion of its high-interest secured debt. This successful refinancing, often overshadowed by the perpetual focus on quarterly losses and revenue misses, is the unexpected structural shift that truly alters the financial risk profile of Plug Power, forcing a re-evaluation of its immediate survivability even as the stock price drifts in the low $2 range. The prevailing market expectation for Plug Power is a simple, if harsh one: a cash-burning hydrogen pure play stuck in a difficult transition from material handling to large-scale green hydrogen production, continually reliant on dilutive financing to sustain operations. This narrative is reinforced by the latest third quarter 2025 results, which, despite a slight beat on the loss per share metric, missed on revenue, clocking in at $177 million against a $187.33 million forecast. The headline-grabbing news remains the negative net income of over $361 million for the quarter. Yet, the reality beneath these familiar figures is that the market cheered the results with an 11.7% aftermarket surge, a reaction not to profitability, but to the stated improvement in operating cash burn and a significant sequential increase of 46% in the Gen Echo electrolyzer business revenue, which signals tangible progress in the high-margin growth segment the market is supposed to care about. The tension lies right there. The stock trades like a company facing imminent liquidity crisis, yet operational improvements and decisive refinancing suggest a management team that is successfully buying itself time to execute its long-term strategy in a capital-intensive industry. Examining the recent trading mechanics, the movement in PLU stock has been choppy, reflecting a struggle between short-term bearish pressure and long-term narrative buyers. The daily volume on Friday was robust, approaching 94.5 million shares, which is relatively high and indicative of significant institutional and retail jockeying for position. In the 5 trading days leading up to the market close, the stock managed a gain of over 9%, recovering from the deep sell-off that followed the broader market's reaction to the slightly disappointing revenue figures and the convertible note offering announcement itself. This quick bounce suggests that there is a floor of buyers willing to step in when the stock nears the $2 support level, likely comprised of longer-term investors who see the current price as a discount on the future value of the hydrogen ecosystem that Plug is building. We've also seen notable institutional activity, such as Legal & General Group (LPC) acquiring over 6 million shares in late November, which pushes the overall institutional ownership close to 95%. This type of large-scale long-only institutional accumulation provides a quiet but powerful counterbalance to the highly visible short-selling activity. The dynamics of short-selling pressure are, as is often the case with this stock, a central element of the trading reality. The latest available short interest data is telling. A massive 305 million shares were held short as of the mid-November settlement date, representing approximately 23.29% of the total free float. This is an extremely high percentage and classifies Plug Power as a stock under significant short seller scrutiny. The short thesis is straightforward. The company is perennially unprofitable, its hydrogen infrastructure build-out is enormously expensive, and the promise of a green hydrogen economy remains heavily dependent on government subsidies and volatile energy markets. Firms engaging in these large shorts are betting that the sustained negative cash flow will necessitate further dilutive equity raises, or that a technical failure in their ambitious infrastructure plans will crush the stock price. The days-to-cover ratio, a measure of how long it would take short sellers to cover their positions based on average trading volume, stands at around 3.4, which is high enough to suggest that a sudden spike in price could cause short sellers some pain. For the retail investor watching the tape, understanding this short activity is vital. The cost to borrow the shares, which short sellers must pay, has remained relatively low, hovering just below 1% for the past week. A low borrow rate is often a signal that there is ample supply of shares available to be lent out, which reduces the cost burden for short firms and makes a short squeeze less likely to ignite. However, the volume of off-exchange short activity, as reported by FINRA, has been consistently high, often exceeding 50% of the total off-exchange volume. This is the kind of data point that fuels debates on Reddit and X, where users frequently call for greater transparency and question the mechanics of dark pool trading. An actionable insight for investors is to track the next mid-month short interest report closely. A reduction in the total number of short shares could indicate that major short players are beginning to close positions, which would be an extremely bullish signal, whereas an increase would confirm that institutional bearish conviction remains high despite the refinancing. Do you think the government will pass legislation in favor of the cannabis industry anytime soon? Or is the hydrogen sector a much safer long-term bet for clean energy legislation? Comment below with your perspective on where the regulatory focus will land next year. To understand why this stock generates such extreme tension, we must briefly ground ourselves in the company's core business model. Plug Power is an integrated provider of hydrogen fuel cell systems primarily for the material handling market. Think forklifts and warehouse equipment for major clients like Amazon and Walmart, which remains a stable, if lower margin, foundational business. The critical growth aspect, and the source of all the market drama, is the company's ambitious plan to become a vertically integrated provider of green hydrogen, producing it via electrolysis using renewable electricity, liquefying it, and distributing it through its own network of hydrogen plants. This build-out requires massive capital, but if successful, it moves them from being a provider of components to a provider of a fundamental industrial fuel source. Recent news, such as the new NASA liquid hydrogen contract and a letter of intent with Hy2Gen for a 5-megawatt electrolyzer project in France, provides tangible proof points that this strategy is beginning to bear fruit outside of the material handling core. This shift to full vertical integration is what captures the imagination, but it is precisely the cost and complexity of this transition that feeds the bearish sentiment. Looking ahead, the future outlook for Plug Power hinges entirely on execution and timing, framed by the expectation of continuing losses versus the reality of accelerating revenue from the Gen Eco and liquefaction segments. The company has publicly targeted EBITDA positivity by the second half of 2026, a commitment that serves as a high-stakes expectation against reality will be measured. The catalysts for a positive move are clear. A large-scale Department of Energy loan guarantee, which has been in the works, would substantially de-risk the financing for their plant build-out and could trigger a significant repricing of the stock. Furthermore, continued strong sequential growth in the electrolyzer business, especially in international markets like the UK and France, and securing more significant multi-year hydrogen supply contracts will validate the vertical integration model. On the other hand, the primary risk is, as always, liquidity, and the possibility of another highly dilutive equity raise if the hydrogen plants take longer to commission or if their operating costs run higher than projected. The specter of insider selling, such as the sale of 50,000 shares by the CEO in recent months, also contributes to a negative sentiment loop, raising questions about management's confidence even if the sales are planned or small relative to the overall market cap. It